Private companies in India have various sources of funding to raise capital for their business operations and expansion. Some common sources of funding for private companies in India include equity funding. Private companies can raise capital by selling shares or ownership stakes to investors. Equity funding can come from founders, family and friends, angel investors, venture capital firms, private equity investors, and institutional investors. Debt financing. Private companies can borrow money from financial institutions, banks, non-banking financial companies, NBFCs, or private lenders. Debt financing can be in the form of loans, debentures, or other debt instruments. Angel investors. Angel investors are high net worth individuals who invest their personal funds in startups and early-stage companies in exchange for equity ownership. Venture capital (VC) funding. Venture capital firms provide funding to startups and early-stage companies with high growth potential. In addition to capital, VC firms often offer mentorship and strategic guidance. Private equity (PE) funding. Private equity investors invest in established private companies to acquire significant ownership stakes. PE firms aim to improve the company's performance and later exit with a profit. IPO, initial public offering. While private companies start with limited ownership, they have the option to go public through an IPO. By offering shares to the public, they can raise substantial capital. Bank loans and credit. Private companies can secure loans and lines of credit from banks and financial institutions to finance their business activities. NBFC financing. Non-banking financial companies provide various financial products, including loans and other debt instruments, to private companies. Government schemes and grants. Some private companies may be eligible for funding through government schemes, subsidies, grants, or incentives designed to support specific industries or promote entrepreneurship. Corporate bonds. Private companies with a strong credit rating can issue corporate bonds to raise capital from the debt market. Bootstrapping. In the initial stages, private companies may fund their operations through bootstrapping, which means using personal savings, revenue generated from sales, or reinvesting profits. It's essential for private companies to carefully consider the terms and conditions of each funding option and choose the one that aligns with their business goals and growth strategy. Additionally, legal and financial advisors can provide valuable guidance in selecting the most suitable funding sources and ensuring compliance with relevant regulations.